If you were one of the people screaming silver to 129 and then woke up to an $80 print, I get it. That wasn't a dip. That felt like a trapdoor. To the Wall Street Bets crowd, to the US and European stacker community, to every person who's been building a little tower of coins with stubborn pride, this video is for you. Because the silver squeeze didn't die from one headline. It died from how modern markets actually work. And the brutal part? You can be right about the long-term story and still get wrecked in the short-term plumbing. Tonight we're going to walk through how a $120 dream turned into an $80 nightmare in basically one trading breath. No cheerleading, no doom porn, just the mechanics, the psychology, and the real checklist you should be watching next. Let's rewind. Silver goes vertical. Every chart looks like a rocket. Group chats turn into war rooms. Memes start printing money. People who never cared about metals suddenly learn the word delivery. And here's what happens in every squeeze narrative. The story becomes clean. Shorts are trapped. Physical is gone. It can only go up. That story can be directionally true, while the trade itself becomes dangerously crowded. Because when everybody discovers the same trade at the same time, the market doesn't become safer. It becomes thinner. One push the other way, and there's nobody left to catch you. Why silver turns savage. Silver isn't just cheaper gold. It's a smaller, tighter market with a split personality. Part money, part industrial input. That's why it can feel calm for months, and then go feral in days. In a smaller market, it takes less capital to move price. That's great on the way up. It's horrifying on the way down. And silver attracts leverage like a magnet, because the contract size feels manageable, because the percentage moves look irresistible, because people think, if I'm right, I'll be right fast. That's the seed of the wipeout. Speed plus leverage inside a thinner market. Most people think squeezes end because the story is wrong. Sometimes they end because the leverage is too high. Here's the uncomfortable truth. The silver squeeze wasn't just coins and bars. It was futures. It was options. It was leveraged ETFs. It was momentum funds. It was day traders using margin. It was algorithms that don't care about your thesis. That matters because paper silver can expand like a balloon. Physical silver can't, so price can overshoot fast, but it can also snap back fast when the balloon gets poked. And when silver was screaming toward $120, the market structure was practically begging for a wipeout. Too many late longs, too many tight stop losses stacked under the same levels, too many dealers hedging short gamma, too many margin accounts living on borrowed time. Too many, I'll just add if it dips, promises sitting under the market. You could feel it in the tape. Bigger candles, faster reversals, insane spreads. That's not strength. That's instability. The 36-hour story in real time. The crash doesn't start with a siren. It starts with a wobble. Hour 1. Price tags the euphoric zone. Everyone stares at the same round numbers. $120 is a magnet. It's also a cliff edge, because round numbers are where a lot of orders live. Hour 3. The first hard red candle hits. Nothing dramatic at first, just enough to rattle the late longs. The chat turns from "when moon" to "is this normal?" Hour 6. A second wave hits. Now it's not fear, it's reflex. Stops begin to cascade because everyone used the same obvious levels. Hour 9. Liquidity thins. The order book looks like Swiss cheese. A move that should take a day happens in minutes. Hour 12. The market tries to bounce. People call it the dip. But bounces in a wipeout are often liquidation bounces, short covering and forced re-hedging, not real buying. Hour 18. Margin pressure starts biting, not just for retail, for anyone using leverage with tight collateral. Hour 24. You see the waterfall candles, the kind that make you feel nauseous. That's usually the moment when accounts are being forced out at market, not choosing exits. Hour 30. Panic meets exhaustion. Some buyers finally show up, but they demand a discount, and the discount becomes the new price. Hour 36. The market prints numbers that felt impossible 2 days ago, and the story flips from squeeze to collapse. That's how it happens. Not one event, but a chain reaction across time zones, risk systems, and liquidity. The first domino, liquidity, vanishes. So how do you go from $120 to $80? You don't fall in a straight line because everyone changed their mind. You fall because liquidity disappears. Picture the market like a busy highway. Normally there are lanes, exits, and guardrails. In a panic, the guardrails move, the lanes shrink, and then the lights go out. When volatility spikes, market makers widen spreads or pull quotes to protect themselves. That's rational for them. But for you, it means there are fewer real bids. So the first wave of selling doesn't find a normal buyer. It finds a vacuum. And a vacuum is where small drops turn into cliff dives. The second domino, stops and margin. Now the technical stuff kicks in. Stops trigger. Not because people are weak, because risk systems are automatic. Then margin pressure hits. If you're leveraged and price moves against you fast, your broker doesn't care about your conviction. They care about collateral. When collateral breaks, positions get forced out. Forced selling is different from I chose to sell. Forced selling is a fire alarm. Everyone runs at once. And once that starts, the selling feeds itself. Drop, stops, margin calls, liquidation, drop again. That is the signature of a liquidity wipeout. Scene 7. Exchange risk controls. The ladder gets pulled. Here's the part that shocks new traders. When volatility explodes, the rules tighten. Risk controls are designed to protect the system, not your entry price. So during violent swings, you often see higher margin requirements, reduced leverage, tighter risk limits at brokers, wider spreads, some products temporarily restricting new positions, order types that fail to fill the way you expected. To a retail trader, that feels like the floor moving. Because it is. The market doesn't owe you an exit. It offers you a bid, and sometimes that bid is ugly. Algorithms provide liquidity until they don't. When the move becomes too fast, many liquidity providers step back to recalibrate. That creates a no-bid moment, an air pocket. In an air pocket, price doesn't travel smoothly. It teleports from level to level as it hunts for the next real buyer. That's why you can watch the chart and think, this can't be real. It's real. It's just mechanical. Options. The invisible hand pushing down. If you want the real why so fast, look at options. When a market rips higher, a lot of traders buy calls. Dealers who sell those calls hedge by buying the underlying. That dealer hedging can amplify the upside. But when the move reverses, the hedging flips. Dealers start selling the underlying to stay neutral. In high volatility, that selling can accelerate the downside. This is why the drop can look engineered. It is engineered by math, not by a meeting. It's a feedback loop built into modern derivatives. 7 trillion erased in 36 hours. Now about that number. When people say 7 trillion erased, they're usually talking about a broad paper value wipeout across the complex. Futures exposure, options notional, leveraged products, and correlated assets that were positioned the same way. In other words, the squeeze trade wasn't isolated. It was connected. When the squeeze cracked, a lot of crowded risk came off at once. And when crowded risk comes off at once, the screen turns red everywhere. That's why it felt like the whole room tilted. Whether the exact number is 7, 5, or 9, the point is the same. The unwind was massive, fast, and largely automatic. Why retail felt betrayed. If you're a stacker, you probably didn't buy because you wanted a quick flip. You bought because you don't trust paper promises. You bought because you like owning something real. You bought because you've watched shortages, delays, and premiums for years. So when price collapses, it feels like reality got ignored. But remember, price is set in paper markets first. Physical tightness shows up second, through premiums, back orders, and delivery stress. They are related, but not identical. A paper-driven crash can happen even when physical demand stays strong. It's weird, but it's normal. 5 myths that get people hurt. Myth 1. If physical is tight, price can't drop. It can, because paper can liquidate faster than physical can respond. Myth 2. A squeeze is a straight line. No, it's a staircase with trapdoors. Myth 3. Conviction beats leverage. Conviction doesn't pay margin calls. Myth 4. If everyone agrees, it's safer. If everyone agrees, it's crowded. Myth 5. The chart is the truth. The chart is the record of transactions. The truth is who is forced, who is free, and who is providing the bid. The squeeze didn't die, the hype did. Here's the key distinction. A squeeze narrative can be right about fundamentals and still be wrong about timing. What died in 36 hours was the fantasy that silver only moves one direction. What died was the idea that leverage is free. What died was the belief that crowd energy can overpower market structure forever. The long game, industrial demand, strategic stockpiles, supply constraints, those don't change overnight. But the short game, positioning, leverage, options, margins, can vaporize you overnight. So if you want to survive this market, you need 2 separate lenses. The real-world metal lens, the paper market plumbing lens. Most people only use one. That's why they get blindsided. What to watch next? The real checklist. If you want to know whether this was the death or just the cleanse, stop staring at the 1-minute chart and watch the plumbing. Physical premiums. Are coin and bar premiums collapsing or staying stubborn? Premiums staying high while spot drops can signal real demand. Availability and delays. Watch reports of back orders, rationing, and long lead times. If everything is suddenly in stock, that's different. If inventory is still patchy, that's also different. Futures spreads. Are near-month contracts trading tight versus later months? Tight spreads can hint at stress and supply. Loose spreads can hint at comfort. volatility and margin behavior. When volatility stays elevated, forced selling can keep happening. When volatility cools, the market can breathe again. Open interest plus volume behavior. If open interest collapses, that's the unwind finishing. If it rebuilds fast, the casino is reloading. ETF flows and share creation, redemption, big outflows can add pressure. Stabilization can remove pressure. Dealer behavior around key strikes. If price pins near popular option strikes, that's hedging gravity. If it breaks away with force, the hedging changes. This is how you stop guessing and start observing. The personal playbook. Survive the next whip. Now the part nobody wants to hear. Most squeezes are designed by emotion and finished by math. The crowd buys late because the story feels safe at the top. Then the crowd sells late because the pain feels unbearable at the bottom. That cycle is how money transfers from impatient hands to patient hands. So here are practical guardrails, frameworks, not instructions. Guardrail. A. Never let one trade become your identity. If your emotions rise and fall with a ticker, the market owns you. Guardrail B. Build a buffer. If your life requires selling at the worst moment, you're playing without oxygen. Guardrail C. Scale. Don't leap. Entries and exits done in pieces keep you from betting your future on one timestamp. Guardrail D. Respect the difference between I want exposure and I want adrenaline. Those are not the same goal. So what happens now? After a crash like this, there are usually three phases. Phase 1, the shock. People freeze. Spreads stay wild. Rumors fly. Phase 2, the blame. Everyone searches for a villain. Everyone wants one clean explanation, but the market is a machine, not a courtroom. Phase 3, the rebuild. The trade becomes unpopular. Volume calms. Then, quietly, strong hands start accumulating again. If silver is truly a long-term squeeze story, it won't look heroic next. It will look boring. It will look hated. That's usually where the foundation forms. So here's the question you should ask yourself right now. Did you buy silver because you wanted to own metal, or because you wanted to be right fast? Both are human. But they require different strategies, different time horizons, and different expectations of pain. And if you're still here after this wipeout, that's not weakness. That's education you paid for with emotion. Here's the trick. After a wipeout, the first bounce is rarely the new bull market. It's usually a test of whether forced selling is finished. A healthy rebound has two tells. The candles get smaller, and the market stops reacting like it's terrified. You'll see steadier bids, tighter spreads, and fewer violent whipsaws. If every rally instantly gets slammed and every dip feels like a free fall, the unwind is still alive. So don't ask, is the story true? Ask, is the market stable enough to express the story without leverage blowing it up again? That one question will save you more money than any meme ever will. Also, watch where volume returns. Does it come in near former breakout zones or only after another flush? And watch the physical signals at the same time, premiums, delays, and dealer inventories. When paper calms but physical stays firm, that's when the market starts to whisper again. That's the line between noise and trend. So no, the silver squeeze didn't die because you were stupid. It died because too much leverage tried to ride a narrow bridge at the same time, and the bridge snapped. The lesson isn't to quit. The lesson is to upgrade your lens. If you're in the US or Europe and you've been stacking, tell me in the comments. Did you buy the top, buy the dip, or step back? And what do you watch? Spot price, premiums, or delivery? One word in the comments. Price or plumbing? I want to see what camp you're in. Stay sharp, stay patient, and I'll see you in the next one.